Question 1. Premium structure and calculation. John, a 45-year-old non-smoker, applies for a 20-year term life insurance policy with a face value of $500,000. He is classified as at standard risk. Given his profile, which of the following factors is least likely to influence the premium he will pay? A. His current health condition. B. His smoking status. C. The fact that he plans to convert to a whole life policy in the future. D. His age at the time of application. Answer: C. The fact that he plans to convert to a whole life policy in the future. Explanation: HD. Age is a major factor in determining term life insurance premiums, although applicants tend to pay higher premiums because they are seen as higher risk. Health condition: A. Health significantly affects premiums. Conditions such as high blood pressure or heart disease increase risk and thus premiums. Smoking status: B. Smoking greatly influences premium rates, as smokers are at higher risk of mortality. Conversion to a whole life policy: C. While conversion options are important for policyholders, the intention to convert does not impact the premium for the initial term life policy itself. Premiums are primarily based on risk factors present at the time of the term policy application, such as age, health, and smoking status. Conversion options typically affect future premium calculations after the conversion, but not during the term period. Question 2. Contestability period scenario. Emma purchases a 10-year term life insurance policy with a death benefit of $250,000. 2 years after purchasing the policy, she unfortunately passes away in an accident. Upon investigation, the insurer discovers that Emma had inaccurately stated her health condition during the application process, failing to disclose a pre-existing illness. What is the insurer most likely to do in this situation, given South Dakota's regulations on contestability? A. Deny the claim outright due to misrepresentation. B. Pay the death benefit but deduct any unpaid premiums. C. Pay the claim in full since the contestability period has passed. D. Investigate further and pay only a reduced portion of the benefit. Answer: C. Pay the claim in full since the contestability period has passed. Explanation: contestability period. In South Dakota, the contestability period for life insurance is 2 years from the date of policy issuance. During this period, the insurer can deny a claim or rescind the policy if misrepresentation or fraud is discovered. However, once the 2-year contestability period has passed, the insurer cannot contest the policy based on any misstatements made during the application process. In this case, because Emma passed away after the contestability period had expired, the insurer is generally obligated to pay the death benefit in full, even if misrepresentations were found in her application. Option A is incorrect because the contestability period has expired. Option B is incorrect as unpaid premiums do not affect the outcome in this context. Option D is incorrect because the contestability period has expired and the insurer is no longer able to investigate misrepresentations. Question 3. Policy structure and features. Which of the following statements about beneficiaries in a term life insurance policy is correct? A. A contingent beneficiary will only receive the death benefit if the primary beneficiary is deceased when the insured passes. B. A policyholder cannot change the beneficiary designation without the consent of the beneficiary. C. A revocable beneficiary cannot be changed once named in the policy. D. A primary beneficiary and a contingent beneficiary must receive equal portions of the death benefit. Answer A. A contingent beneficiary will only receive the death benefit if the primary beneficiary is deceased when the insured passes. Explanation: contingent beneficiary. A. The contingent beneficiary is the person who receives the death benefit only if the primary beneficiary has died or is otherwise unable to claim the benefit. This is a standard feature of life insurance policies. Option B is incorrect because a policyholder can typically change a beneficiary without the beneficiary's consent if the designation is revocable. Option C is incorrect because a revocable beneficiary can be changed by the policyholder without needing the beneficiary's permission. If the beneficiary is irrevocable, then the policyholder would need the beneficiary's consent for any changes. Option D is incorrect because there is no requirement that the primary and contingent beneficiaries must receive equal portions of the death benefit. The policyholder can decide how to allocate the death benefit among the beneficiaries. Question 4. Riders and additional coverage. Which of the following riders allows a policyholder to access part of their death benefit while still alive if diagnosed with a terminal illness? A. Accidental death rider. B. Waiver of premium rider. C. Accelerated death benefit rider. D. Critical illness rider. Answer: C. Accelerated death benefit rider. Explanation. Accelerated death benefit rider C allows a policyholder to receive a portion of the death benefit if diagnosed with a terminal illness or, in some cases, a critical condition. This helps the insured cover medical expenses or other financial needs while still alive. Accidental death rider A pays an additional benefit if death occurs as the result of an accident, but does not offer benefits during the insured's lifetime. Waiver of premium rider B allows premiums to be waived if the policyholder becomes disabled but does not provide living benefits. Critical illness rider D covers specific critical illnesses, but it does not function the same way as an accelerated death benefit. It typically offers a lump sum payment upon diagnosis of certain illnesses separate from the death benefit. Question 5. Decreasing term insurance. Decreasing term insurance is often used for what specific financial purpose? A. To fund a child's education. B. To pay off outstanding mortgage debt. C. To provide for retirement income. D. To cover end-of-life expenses. Answer. B. To pay off outstanding mortgage debt. Explanation. Decreasing term insurance B is designed for situations where the need for coverage decreases over time, such as repaying a mortgage. As the mortgage balance declines, the death benefit reduces accordingly, aligning with the outstanding debt. Option A. While education costs might increase over time, decreasing term insurance wouldn't be suitable since the death benefit reduces. Option C is incorrect, as retirement income requires steady or increasing funds, not decreasing coverage. Option D is incorrect because end-of-life expenses are often covered by permanent life insurance or final expense insurance, not decreasing term insurance. Question 6. Claims process. A claim for a death benefit is submitted 2 months after the insured dies. The insurance company requests a death certificate and confirms the policy is in good standing. However, the company delays payment, citing internal processing issues. According to South Dakota regulations, what is the likely action the beneficiary can take? A. Wait for the processing period to end, as there is no required time for payment. B. File a complaint with the South Dakota Division of Insurance, as insurers must pay claims within a specified time frame. C. Request a refund of all premiums paid under the policy. D. Submit a lawsuit immediately against the insurer. Answer. B. File a complaint with the South Dakota Division of Insurance, as insurers must pay claims within a specified time frame. Explanation. Under South Dakota state regulations, insurers are required to pay valid death benefit claims within a reasonable time frame, typically 30 to 60 days after receiving all necessary documents like the death certificate. Option B is correct because the beneficiary can file a complaint if the insurer unreasonably delays payment beyond the prescribed time frame. Option A is incorrect because there are time limits for paying claims. Option C is incorrect because the claim is about the death benefit, not a refund of premiums. Option D is incorrect because lawsuits are usually a last resort after regulatory complaints. Question 7. Taxation and legal implications. Which of the following best describes the tax treatment of death benefits under a term life insurance policy? A. Death benefits are taxable as ordinary income. B. Death benefits are tax-exempt for the beneficiaries. C. Death benefits are only taxable if they exceed $1 million. D. Death benefits are taxed as part of the insured's estate. Answer. B. Death benefits are tax-exempt for the beneficiaries. Explanation. Option B is correct because death benefits paid to beneficiaries are generally not subject to federal income tax. This is a major advantage of life insurance policies. Option A is incorrect as death benefits are not considered ordinary income. Option C is incorrect since there is no threshold at which death benefits become taxable for the beneficiaries. Option D is incorrect. Though estate tax could apply if the deceased's estate exceeds certain thresholds, the death benefit itself remains tax exempt for the beneficiaries unless it's paid to the estate. Question 8. Scenario-based conversion options. David has a 10-year term life insurance policy and he is halfway through the policy term. He has recently experienced a significant change in his health, making him ineligible for a new life insurance policy at standard rates. David is considering converting his term policy to a whole life policy. What is the most important consideration he should take into account? A. The conversion deadline specified in the policy. B. The need to undergo a new medical exam. C. The increase in death benefit upon conversion. D. The fact that his premiums will stay the same after conversion. Answer A. The conversion deadline specified in the policy. Explanation. Conversion deadline A is the most critical factor because most term policies have specific deadlines by which the policy must be converted to permanent insurance. If David misses this deadline, he may lose the option to convert. Option B is incorrect because conversions typically do not require a new medical exam, which is why it's advantageous for someone in poor health like David. Option C is incorrect because the death benefit typically stays the same upon conversion unless additional coverage is purchased. Option D is incorrect because premiums usually increase after conversion, as whole life insurance is more expensive than term insurance. Question 9. South Dakota specific requirements. According to South Dakota insurance laws, which of the following must be provided to a policyholder within the free look period? A full refund of premiums if the policyholder decides to cancel the policy. B. A partial refund based on the time the policy was in force. C. The right to convert the policy to a permanent one without penalties. D. An option to decrease the death benefit and adjust premiums accordingly. Answer A. A full refund of premiums if the policyholder decides to cancel the policy. Explanation. Free look period A in South Dakota requires insurers to provide policyholders a period, typically 10 days from receipt of the policy, to review the terms and cancel if they are not satisfied. If cancelled during this period, the policyholder is entitled to a full refund of any premiums paid. Option B is incorrect because the refund must be full, not partial. Option C is irrelevant to the free look period as conversion options are unrelated to cancelling during the free look. Option D is incorrect as this is not an option offered during the free look period. Question 10. Replacement of term life insurance. Which of the following is a required step when replacing a term life insurance policy in South Dakota? A. No special procedures are required for policy replacements. B. The agent must provide a written comparison of the existing policy and the new policy. C. The insured must pay an additional tax on the replacement policy. D. The insured must waive any remaining death benefits on the existing policy. Answer B. The agent must provide a written comparison of the existing policy and the new policy. Explanation. South Dakota insurance regulations B. require that when a term life insurance policy is being replaced, the agent must provide a written comparison showing the differences between the old and new policies. This ensures that the policyholder is fully informed before making a decision. Option A is incorrect because South Dakota law mandates procedures for replacements. Option C is incorrect as no additional tax is required specifically for replacements. Option D is incorrect because the insured does not have to waive any remaining death benefits. The old policy can simply be cancelled. Question 11. Premium structures and calculation. Which of the following factors is most likely to result in higher premiums for a term life insurance policy? A younger age at the time of application. B. Excellent health classification during the underwriting process. C. A history of smoking. D. Annual premium payments instead of monthly payments. Answer C. A history of smoking. Explanation. Option C is correct because smoking is a significant risk factor that increases life insurance premiums. Smokers are more likely to have health issues that could lead to a shorter lifespan, making them a higher risk to the insurer. Option A is incorrect because younger applicants generally pay lower premiums. Option B is incorrect because an excellent health classification usually results in lower premiums. Option D is incorrect because annual payments often reduce the overall cost of insurance due to fewer administrative fees compared to monthly payments. Question 12. Policy structure and features. In a term life insurance policy, what is the primary purpose of the face value? A. It determines the amount of premiums paid. B. It represents the death benefit paid to beneficiaries. C. It dictates the duration of the policy. D. It outlines the conditions for policy renewal. Answer B. It represents the death benefit paid to beneficiaries. Explanation. Option B is correct because the face value of a term life insurance policy is the amount of money the beneficiaries will receive as a death benefit if the insured dies during the policy term. Option A is incorrect as premiums are influenced by multiple factors, not just the face value. Option C is incorrect because the face value refers to the death benefit, not the policy duration. Option D is incorrect because the face value does not determine renewal conditions. Question 13. Contestability period. During the 2-year contestability period, the insurer can deny a claim if A. The insured dies of natural causes. B. The insured made a material misrepresentation on the application. C. The beneficiary submits the claim late. D. The policyholder failed to name a contingent beneficiary. Answer B. The insured made a material misrepresentation on the application. Explanation. Option B is correct because during the 2-year contestability period, insurers can deny a claim if they find that the policyholder misrepresented important information such as their health or smoking status on the application. Option A is incorrect because natural death itself does not trigger a claim denial unless fraud or misrepresentation is involved. Option C is incorrect because late submission of a claim does not affect the contestability period. Option D is incorrect because not naming a contingent beneficiary would not result in denial, or the death benefit would go to the estate or legal heirs if there are no beneficiaries. Question 14. Renewable term insurance. Which of the following best describes a key feature of renewable term insurance? A. Premiums decrease over time as the policy is renewed. B. The policyholder can renew without a medical exam, but premiums increase with each renewal. C. The death benefit increases with each renewal period. D. The policy automatically converts to permanent life insurance after the first term. Answer: B. The policyholder can renew without a medical exam, but premiums increase with each renewal. Explanation: Option B is correct because renewable term insurance allows policyholders to renew the policy at the end of the term without undergoing a new medical exam. However, the premiums increase based on the policyholder's age at renewal. Option A is incorrect because premiums typically increase with age upon renewal, not decrease. Option C is incorrect because the death benefit remains the same though premiums rise. Option D is incorrect as the policy does not automatically convert to permanent insurance. That option is typically available with convertible term insurance. Question 15. Scenario-based application process. Sarah is 40 years old and applies for a $500,000 20-year term life insurance policy. During the underwriting process, it is revealed that Sarah has a family history of heart disease, though she is currently in good health. Based on this information, what risk classification is Sarah most likely to receive? A. Preferred. B. Standard. C. Substandard. D. Guaranteed issue. Answer: B. Standard. Explanation: Option B is correct because while Sarah is currently in good health, the family history of heart disease may prevent her from qualifying for a preferred classification. Insurers often place applicants with family medical histories of serious conditions into a standard risk class. Option A is incorrect because the family history of heart disease likely disqualifies her from the preferred risk class. Option C is incorrect because substandard is typically reserved for applicants with significant personal health issues, which Sarah does not have. Option D is incorrect because guaranteed issue policies do not require medical underwriting but usually have lower coverage amounts and higher premiums. Question 16. Riders and additional coverage. Which rider allows a policyholder to stop paying premiums if they become permanently disabled? A. Accelerated death benefit rider. B. Accidental death rider. C. Waiver of premium rider. D. Return of premium rider. Answer: C. Waiver of premium rider. Explanation: Option C is correct because the waiver of premium rider ensures that if the policyholder becomes permanently disabled and unable to work, they can stop paying premiums and the policy will remain in force. Option A is incorrect because the accelerated death benefit rider allows access to the death benefit in case of terminal illness, not for disability. Option B is incorrect as the accidental death rider provides an additional death benefit if the insured dies as a result of an accident. Option D is incorrect because the return of premium rider refunds premiums if the insured outlives the term but does not relate to disability. Question 17. Replacement of term life insurance. When replacing a term life insurance policy, South Dakota law requires the policyholder to receive A. a new medical exam regardless of previous underwriting results, B. a full refund of all premiums paid on the old policy, C. a notice explaining the potential consequences of replacement, D. a guaranteed reduction in premium costs. Answer: C. A notice explaining the potential consequences of replacement. Explanation: Option C is correct because South Dakota law requires that the policyholder be provided with a written notice explaining the potential consequences of replacing their existing policy. This is to ensure the policyholder understands any risks, such as losing certain benefits or incurring higher premiums. Option A is incorrect because a new medical exam may not always be required, especially if the insured is within the same underwriting period. Option B is incorrect as no refund of previous premiums is provided for the old policy unless the free look period applies. Option D is incorrect because premiums could increase based on the age and health of the policyholder when replacing the policy. Question 18. Types of term life insurance. Which type of term life insurance offers a death benefit that decreases over time and is often used to cover declining debts? A. Level term insurance. B. Renewable term insurance. C. Convertible term insurance. D. Decreasing term insurance. Answer: D. Decreasing term insurance. Explanation: Option D is correct because decreasing term insurance provides a death benefit that reduces over time, often used to cover debts that diminish, such as mortgage loans. Option A is incorrect because level term insurance maintains a constant death benefit throughout the term. Option B is incorrect because renewable term insurance allows renewal without a medical exam but does not reduce the death benefit. Option C is incorrect because convertible term insurance allows conversion to a permanent policy but does not involve a decreasing death benefit. Question 19. Underwriting process. During the underwriting process for term life insurance, which factor is least likely to affect the applicant's premium? A. The applicant's occupation. B. The applicant's smoking status. C. The applicant's age. D. The applicant's choice of beneficiary. Answer: D. The applicant's choice of beneficiary. Explanation: Option D is correct because the beneficiary designation does not affect the premium. The premium is based on factors related to the risk of insuring the applicant, not on who will receive the death benefit. Option A is incorrect because certain high-risk occupations, e.g. mining, firefighting, can result in higher premiums. Option B is incorrect as smoking status is a major factor that increases premiums. Option C is incorrect because age directly impacts premiums, with younger applicants generally paying lower premiums. Question 20. Legal and regulatory aspects. Under South Dakota law, what is the typical free-look period during which a new term life insurance policyholder can cancel the policy and receive a full refund? A. 5 days. B. 10 days. C. 30 days. D. 60 days. Answer: B. 10 days. Explanation: Option B is correct because South Dakota law requires insurers to offer a 10-day free-look period during which new policyholders can cancel the policy for any reason and receive a full refund of any premiums paid. This free-look period allows policyholders to review the terms and conditions of the policy without financial risk. Option A is incorrect because 5 days is not the standard free-look period in South Dakota. Option C is incorrect because while some states may have longer free-look periods for specific policies, 30 days is not typical for term life insurance in South Dakota. Option D is incorrect as a 60-day free-look period would be unusually long and is not the standard for term life insurance policies in South Dakota. Question 21. Policy structure and features. In term life insurance, which of the following is true about a revocable beneficiary? A. The beneficiary cannot be changed without their consent. B. The policyholder can change the beneficiary at any time without the beneficiary's consent. C. The beneficiary has full control over the policy after the policyholder's death. D. The revocable beneficiary automatically becomes irrevocable after a certain period. Answer: B. The policyholder can change the beneficiary at any time without the beneficiary's consent. Explanation: A revocable beneficiary can be changed by the policyholder at any time without the beneficiary's consent. This is one of the primary differences between revocable and irrevocable beneficiaries. Option A is incorrect because this describes an irrevocable beneficiary. Option C is incorrect because the beneficiary does not have control over the policy, only rights to the death benefit after the policyholder's death. Option D is incorrect as revocable beneficiaries do not automatically become irrevocable over time unless otherwise stipulated in a legal agreement. Question 22. Premium structures and calculation. Which factor is least likely to affect the premium calculation for a term life insurance policy in South Dakota? A. The policyholder's smoking status. B. The duration of the policy. C. The policyholder's occupation. D. The beneficiary's health status. Answer: D. The beneficiary's health status. Explanation: The health status of the policyholder, not the beneficiary, affects the premium calculation for a term life insurance policy. Premiums are based on the risk of insuring the policyholder, considering factors like their health, age, occupation, and lifestyle habits, such as smoking. Option A is incorrect because smoking status is a significant factor in determining premium rates. Option B is incorrect because the length of the term, e.g., 10 years, 20 years, directly influences premium amounts. Option C is incorrect because certain high-risk occupations can result in higher premiums. Question 23. Riders and additional coverage. A policyholder adds an accelerated death benefit rider to their term life insurance policy. Under which circumstance can they utilize this rider? A. If they become unemployed. B. If they are diagnosed with a terminal illness. C. If their beneficiary dies before them. D. If they default on a premium payment. Answer: B. If they are diagnosed with a terminal illness. Explanation: an accelerated death benefit rider allows the policyholder to receive a portion of the death benefit if they are diagnosed with a terminal illness, typically with a life expectancy of 12 months or less. This provides financial assistance for medical or end-of-life expenses. Option A is incorrect because unemployment is not a trigger for the accelerated death benefit. Option C is incorrect because the death of a beneficiary does not activate this rider. Option D is incorrect because defaulting on premium payments leads to policy lapse, not accelerated benefits. Question 24. Claims process. A policyholder dies within the first year of the policy. The insurer finds that the policyholder misrepresented their smoking status on the application. What is the most likely outcome during the contestability period? A. The insurer will pay the full death benefit. B. The insurer will deny the claim and refund premiums paid. C. The insurer will pay a reduced death benefit based on the policyholder's actual smoking status. D. The insurer cannot contest the policy after issuing it. Answer: B. The insurer will deny the claim and refund premiums paid. Explanation: during the contestability period, typically the first 2 years of a policy, insurers can investigate claims and deny them if material misrepresentation, e.g., false smoking status, is found. In such cases, the insurer typically refunds the premiums paid but denies the death benefit. This is allowed under South Dakota law if the policyholder provided false information on the application. Option A is incorrect because material misrepresentation allows the insurer to deny the claim. Option C is incorrect because death benefit adjustments based on misrepresentation usually result in claim denial. Option D is incorrect because the contestability period allows claims to be investigated even after the policy is issued. Question 25. Replacement of term life insurance. Which of the following is a requirement under South Dakota law when replacing an existing term life insurance policy with a new one? A. The insurer must offer a higher death benefit. B. The policyholder must undergo a new medical exam. C. The insurer must provide a written comparison of the old and new policies. D. The new policy must be issued at a lower premium than the old one. Answer: C. The insurer must provide a written comparison of the old and new policies. Explanation: under South Dakota law, when a policyholder replaces an existing life insurance policy, the insurer must provide a written comparison of the old and new policies to ensure the policyholder understands any differences, including coverage, premiums, and other key details. Option A is incorrect because there is no requirement to offer a higher death benefit in a replacement policy. Option B is incorrect as a new medical exam is not always required for policy replacement. Option D is incorrect because premium levels can vary depending on the policyholder's risk profile and the new policy's features. Question 26. Taxation and legal implications. In South Dakota, under typical circumstances, which of the following is true regarding the tax treatment of term life insurance death benefits? A. The death benefits are subject to federal income tax. B. The death benefits are subject to South Dakota state income tax. C. The death benefits are generally exempt from federal income tax. D. The death benefits are taxable if the policyholder was self-employed. Answer: C. The death benefits are generally exempt from federal income tax. Explanation: under federal law, death benefits from a term life insurance policy are generally exempt from federal income tax. South Dakota does not impose a state income tax, so the death benefits are also exempt from state taxation. Option A is incorrect because death benefits are typically not subject to federal income tax. Option B is incorrect because South Dakota does not have a state income tax. Option D is incorrect because the tax status of death benefits is not affected by the policyholder's employment type. Question 27. Scenario-based question. Application process. Mr. Richards, a 45-year-old non-smoker with no significant health issues, applies for a $500,000 term life insurance policy. He undergoes a medical exam as part of the underwriting process. Based on his age, health, and lifestyle, the insurer offers him a policy with preferred rates. What does this mean for Mr. Richards? A. He will pay higher premiums due to his age. B. He is receiving low premiums because he is considered low risk. C. His premiums will increase after the first year of the policy. D. He will be required to undergo annual medical exams. Answer: B. He is receiving low premiums because he is considered low risk. Explanation: being classified in the preferred rate class means that Mr. Richards is considered to be low risk by the insurer due to his good health, age, and lifestyle choices, resulting in low premiums than someone in a standard or substandard rate class. Option A is incorrect because while age is a factor, his preferred rating leads to low premiums. Option C is incorrect because preferred rates do not imply increasing premiums after the first year. Option D is incorrect because annual medical exams are not required once the policy is issued unless stipulated in the policy terms. Question 20. Riders and additional coverage. Which of the following is a feature of the waiver of premium rider in a term life insurance policy? A. The policyholder's premiums are waived if they become terminally ill. B. The policyholder's premiums are waived if they become totally disabled and unable to work. C. The policyholder's premiums are waived if they lose their job. D. The policyholder's premiums are waived if they file for bankruptcy. Answer: B. The policyholder's premiums are waived if they become totally disabled and unable to work. Explanation: a waiver of premium rider waives the policyholder's premiums if they become totally disabled and unable to work, ensuring that the policy remains in force without the need for premium payments during the disability. Option A is incorrect because terminal illness is covered under the accelerated death benefit rider, not waiver of premium rider. Option C is incorrect because job loss does not trigger the waiver of premium rider. Option D is incorrect because bankruptcy is not a qualifying condition for the waiver of premium rider. Question 29. Beneficiary designations. If a policyholder names their spouse as the primary beneficiary and their child as the contingent beneficiary, what happens if the policyholder dies and the spouse has already predeceased the policyholder? A. The policy proceeds are forfeited. B. The child receives the death benefit. C. The death benefit is paid to the policyholder's estate. D. The insurer decides who receives the death benefit. Answer: B. The child receives the death benefit. Explanation: if the primary beneficiary, the spouse, predeceases the policyholder, the death benefit will go to the contingent beneficiary, the child. The contingent beneficiary only receives the death benefit if the primary beneficiary is unable to. Option A is incorrect because the policy proceeds are not forfeited if a contingent beneficiary is named. Option C is incorrect because the estate is not involved unless no beneficiaries are named or alive. Option D is incorrect because the insurer does not decide the recipient of the death benefit unless there are no named beneficiaries. Question 30. Decreasing term insurance. Which of the following best describes a decreasing term life insurance policy? A. The death benefit increases over time while the premiums remain level. B. The death benefit decreases over time while the premiums remain level. C. Both the death benefit and premiums increase over time. D. Both the death benefit and premiums decrease over time. Answer: B. The death benefit decreases over time while the premiums remain level. Explanation: in a decreasing term life insurance policy, the death benefit decreases over the policy's term while the premiums typically remain level. This type of insurance is often used to cover decreasing obligations such as mortgage protection. Option A is incorrect because the death benefit does not increase in a decreasing term policy. Option C is incorrect because both the death benefit and premiums do not increase. Option D is incorrect because only the death benefit decreases, not the premiums.